Today's CPI print sent the stock market to fresh all-time highs. We'll also talk about what's going on with the dollar and, of course, the precious metals market in response to this, and we'll dabble into some currencies and crypto as well. As we get started, hit that thumbs up button for me, and let's get started. So let's break down the CPI print that we got this morning. If we zoom in over here, you can see that the red dot represents the forecasted data point that we were expecting for CPI. 3.1% is what the market was expecting for today's print. Instead, we just got 3%. So we would say that this was a better than anticipated or better than feared reading for inflation. But hold up a second, isn't inflation still rising? Isn't this bad for the stock market and for everything? You know, inflation keeps rising, isn't that bad? Remember that markets trade off of expectations versus what really happens. The market was pricing in and anticipating a steeper rise in inflation than we actually got. It's kind of like if I told you that on Saturday it's going to rain all day long, but instead we just had a quick shower in the morning and then it was sunny for the rest of the day. And so the market responded by pushing higher here. Yes, inflation is rising, but let's talk quickly about what the Federal Reserve is up to. The Fed is dealing with two problems at once, where they have sticky inflation, still above their 2% target, and they also have jobs data which shows signs of weakness. To respond to this, the Fed has the choice to cut interest rates or to delay cutting interest rates. Remember that cutting interest rates makes borrowing rates lower for people and businesses and stirs the economy higher. So rate cuts are very much welcomed by the stock market. And so watching the inflation data today, we got some interesting insights. Inflation is not as much of an issue as jobs data is at this time in the eyes of the Federal Reserve. And with a better than expected print like we just got done discussing on CPI, the Fed's going to look at this and say, okay, well, let's move to focusing on the jobs market. How do we administer to the jobs market? We cut interest rates. And Powell has been very deliberate about the plan of the Federal Reserve. They look at both of these things and they say, whichever one is in more dire need of help, we're going to administer to that. And that seems right now to be more the jobs market than it is inflation. And Powell has also mentioned that in the short term, inflation still seems a little sticky, but in the long run, they expect inflation to come down. So eyes are squarely on the jobs market, which means cutting interest rates, which is good for corporate earnings. And for the consumer, first-time home buyers, borrowers, etc. Lower rates are very welcomed in this economy, which especially with the idea of the jobs market needing some help, let's take a look at some data on that. Here's a look at JOLTS job openings. And you can see for the last few years, it's been trending down. And so the Fed making the move to cut interest rates should hypothetically help with this a little bit. You can also see unemployment rate is just gradually rising here recently. So maybe the Fed is just saying, hey, if inflation is ultimately likely headed lower, maybe in the meantime, we can also cut interest rates, which they see as restrictive. Remember, the Fed hiked interest rates dramatically to deal with the dramatic rise in inflation that we saw post-pandemic, getting up to 5.5% on the Fed target rate, now dropping it down and expected to continue to drop it down into year's end. You can see by the fourth quarter, the Fed is expected to cut interest rates pretty sizably. So in response to this, with rate cuts expected to come down the pipeline soon, corporate earnings that look good overall, the stock market is absolutely ripping to fresh all-time highs. And all of the reasons that I just described, plus momentum in price action, are why I am very much still long the stock market and why I took the opportunity during that sell-off that we saw 2 Fridays ago to get long. They say the trend is your friend, and so many traders learn this the hard way, but buying dips in a market where rate cuts are coming, corporate earnings look good. Again, is there eventually a point where the stock market crashes and rollovers? Sure, but until then, the trend is your friend. So here's a look at my NASDAQ position. I'm still long as of my 2 Fridays ago or 3 Fridays ago entry on the big Trump sell-off day where people were worried about tariffs again. Since then, it is now expected that Trump and President Xi are going to meet and they're likely going to come to a deal. And so again, I want to stay positioned for that. I'm not trading necessarily based off of that, but the fear event that took place on that day created a wonderful entry for people who were waiting for proper dips. Today's video is sponsored by a brokerage that I have personally used for the last 5.5 years and absolutely love. The sponsor of today's video is Webull. With Webull, traders can trade US listed stocks, international ADRs, OTC securities, and fractional shares. You can also trade ETFs with access to over 3,300 ETFs. They also offer an advanced screener tool and research platform. And if you're an options trader like myself, you can check out their options platform, which I find personally to be super advanced, but also really easy to use. With their options, you can can execute commission-free trades with support for multi-leg strategies, real-time Greeks, implied volatility data, and both equity and index options. And somewhat more recently, they launched futures as well for those interested in trading all sorts of different futures contracts. You can also buy and sell over 30 different cryptocurrencies within the app. And here's a couple reasons why I personally love Webull. Check this out. First and foremost, when it comes to trading costs, they offer 0 commissions. And that's specifically commission-free trading on stocks, ETFs, and options. However, index options may have low contract fees, regulatory and exchange fees still apply. And one thing that sets Webull apart from the rest is their incredible charting software that they offer. It's super clean, easy to use, and pretty advanced. Their platform includes over 50 customizable indicators, 60 technical signals, for example, candlestick patterns and trend lines, Fibonacci retracements, multiple line styles like Heikin-Ashi, and so much more. And if you want to harness your skills before going live, you can also use their paper trading platform. This allows you to trade with real-time data with a risk-free environment. And just as cool as the desktop app is actually the mobile app, which I use all the time because it is super clean and easy to use. With Webull, you can have a cash account, a margin account, an individual or a joint brokerage account. You can also do traditional or Roth IRAs and rollover IRAs. And while there are so many other reasons that Webull is such a standout brokerage to me and why I've used them personally for the last 5.5 years, maybe the easiest reason as to why I like them so much is their super clean interface and some of the statistics that they actually show you when you are placing trades, etc. For example, the P&L calendar is like a super popular feature, and it's one that I've really loved having over the years. So if you're interested in exploring Webull yourself, check out the link in the description down below, or you can download the app on the App Store and explore it to see if it's a good fit for you. So sign up with my link below and take advantage of all the great offerings Webull has waiting for you. Now back to the video. This week I also added into IWM. I am still long IWM, which is the Russell 2000 index. So I am looking for further upside in small cap stocks, which I think would benefit from rate cuts. And with the great inflation print that we got this morning, the NASDAQ is maintaining a very bullish reading within our system. Specifically, economic data looking good, helped out by strong bullishness from the CPI print. We can also see this in the AI market scanner. We're getting a very bullish reading, +9 score, and you can see under inflation data, we've got a bullish signal thanks to CPI and PPI both coming in as of the latest available data, cooler than expected. So as far as stocks and indices right now, I am very bullish, but trailing stops. So that means I'm not leveraging up, I'm not taking huge gambles or massive risk on my portfolio. I'm taking modest risk and still think that there is upside for stocks going into the fourth quarter. And I know I've referenced this many times in my videos recently, but seasonality also played a key role in the Edge Finder's bullish rating, which suggests that there could be more upside in the fourth quarter for stocks. So far, we are playing in line nicely. And if you're interested in getting access to all of these trades that I'm sharing when I share them, consider joining our VIP group. I'll leave a link in the description down below to where you can sign up if you're interested. But every time I take a trade, indices, stocks, commodities, currencies, every trade that I take gets shared to members. And most importantly, they are backed by verified results. I show you guys in my videos frequently in my live streams, I'm trading on a live brokerage, and I do that to show that the service that I offer is based on or built around real historical track records. So if you're interested in joining us and would like a subscriber discount, check out the link in the description down below. And if you want to check out the Edge Finder this week, here's your free plug. If you have not already gotten access, it is free to use until October 29th. You can explore our seasonality tools, our top setups indicators, and of course our institutional data by tracking commitment of traders and so much more. You can also track market sentiment through the put to call ratio, the AAII investor sentiment surveys, the Bitcoin to gold ratio, which by the way, look at Bitcoin getting beaten down here recently by gold, and endless amounts of economic data as well. Things like NFP reports, job openings, CPI. If you want to explore the same sandbox that I use in my videos, get access to it for free. Here's how. Simply navigate to our Telegram channel, which you can find in the description of this video down below. Once you're there, hit the pinned message at the top, and then just get access here using this form. It's a simple process. All you gotta do is number 1, join the Telegram. Step 2, fill out this form in the pinned message. Once you do that, it will email you access to the Edge Finder, which will be valid until October 29th. And if it's easier for you and you're on a desktop or a TV watching this, you can simply scan the QR code to get access to the Telegram channel, where you can fill out that form to get access to the Edge Finder for free for a limited time. So transparently, here's your chance to try out the tools and see if they're worth purchasing for yourself and your trading strategies and plans in the coming weeks. The dollar index is largely unchanged here. Despite a cooler than expected CPI print, you can still see the dollar index is just really not moving very much right now. And part of the reason for this might be that the euro is also looking pretty weak as well. Remember that currencies trade relative to one another. We also saw very weak inflation or soft inflation compared to expectations for the UK. Let's look at that. So UK inflation came in at 3.8%, though it was expected to come in at 4%. So this, like the US, saw some cool inflation prints weakening the British pound as more rate cuts are expected to come into place for the Bank of England. Though the Bank of England has a unique circumstance, which is difficult when compared to the US. Let me show you. So you're looking at US GDP numbers, which have come in really strong for the second quarter, and we are expected to start getting some data for the third quarter, which is also expected to be strong. But when we contrast that and look at the UK, which has little to no growth, it's not a very exciting story. And so when they have low growth, high inflation, we call this a risk of stagflation in the UK, something that again is not a fun thing to deal with as a central bank. Because what do? Do you cut interest rates? Well, if you do that, inflation could get out of control. Do you hike interest rates? Well, if you do that, the economy crashes. It's a difficult circumstance. And I think when you're thinking about places to trade or invest, at least the way I think about it, is I want to invest in places that have growth. I want to show you something within the Edge Finder too. This is our GDP growth forecast, and you can see that US GDP growth forecast is still really strong when compared to especially its Western peers. Like if you look at the UK, you can see there's little to no growth there, or even expectations going out in the future. Same with Europe in yellow. But then we start looking at some other places. Let's take off the UK and Europe, and you can see there are some strong growth places like India, INR here, or if we take a look at China, CHY, you can see that there's actually some decent growth in these places as well. So this is my personal opinion, not financial advice in any way, but over the longer term, places to invest for me would probably be places that have stronger GDP growth expectations. Like for example, the US, India, and maybe even China. Another one that I like is Brazil. But this is why macro makes a huge difference. In my opinion, the best places to be are places where there's a lot of growth and there's innovation and things like that. So I like the US and I like India as well. One way that I could play this would potentially be looking at the INDA, which is an India ETF. But for now, I'm still very much long US stocks and US indices. We can also take a look at gold. Take a look at the price action of gold. Very strong wicks off of the bottom for the last 3 days, at least for now. We'll see how today's candle closes. But this looks very constructive. And though we have not yet tagged any key level of support looking left, it's possible, at least on the daily chart, it's possible that this moving average, this 20-day moving average, is acting as very strong support without even getting down to this level here. Now, I personally don't have a strong bias one way or the other on gold from a trading perspective, but from a long-term investing perspective, I am and have been invested in gold and silver for the long term. But when we go to our AI market scanner and we select specifically for gold, let's just search gold, what you can see is that the Edge Finder is actually giving a -3 score, which is pretty neutral. And what I mean, or where we're getting that neutrality is overall, seasonally, it's still a decent month for gold. November, by the way, not a particularly great month. And trend reading has flipped to bearish within the Edge Finder here, at least in the recent price action developments. Long term, I still think the trend is intact. Economic growth metrics, however, GDP numbers strong for the US, manufacturing PMIs beat expectations, retail sales strong for the US. That's not particularly bullish for gold. Inflation data, a little bit mixed. CPI today was good for gold, but overall, I want to be kind of in line with the idea of the Edge Finder. And so if we're getting a neutral reading, I'm just going to pass on this. I would also be more interested in gold if you did get bigger retracements, but I'm not really willing to bet that we're going to see a bigger decline in gold. Same with silver. You can see we are hovering around the 20-day moving average. The 50 is still well a ways away. Copper actually holding up really well with the idea, I think, that the global economy could do decent. They call this Dr. Copper for a reason. It's an indicator about the global economy to an extent. Strong demand for copper prices as copper kind of goes in everything that gets manufactured. it's an indicator by itself to look at. Another one to look at is oil prices. And if you know where I'm going with this, you've been watching my videos, because I am looking at oil for a possible breakout buy on a retest of this 62 area. If essentially we see a strong breakout to the upside, kind of breaking this downward channel that we've seen on the daily chart, I like oil to the upside. In fact, if we pull up Edge Finder's reading on oil, you can see that we've got a nice overall technical signal to the upside. Institutional activity still looks good. Economic growth metrics look good. This would be a buy for me if we can get a breakout to the upside. And remember, if I take that trade, I will share that inside of our Discord, as I do with every trade I take. Bitcoin still sitting around this support at 108,000. We'll see if it can make a big decisive move either direction. I got faked out a little bit on Bitcoin. I went long here and ultimately stopped out, but I'm perfectly fine with it. Actually, there's some things that are moving better than crypto at this time. Crypto is an interesting spot. We've just been consolidating for a while. But path of least resistance, in my opinion, support seems to be holding. I wouldn't be surprised if into year's end we see higher prices in Bitcoin, barring some sort of scary announcement from, China and the US, which is, by the way, a distinct possibility. But not so much in the eyes of the market. You can see the VIX coming down, with essentially the market saying big volatility moves are likely behind us. Does that guarantee that that is the case? Absolutely not. But the market's perception is, hey, things look a lot more clear now. We're going to get a meeting between President Trump and President Xi. Corporate earnings coming in good. Inflation's cooling. Fed's going to cut rates. Things look good. And now I know that what starts to happen in people's brain when I say, hey, things start to look good, is the contrarian in a lot of us starts to say, well, everything looks good. That's exactly when they're going to get you. Yes, but be careful, because that line of thinking can actually get you gotten as well. What I mean by that is a lot of times volatility comes down and it stays down. Like the bull market can continue and make people go insane thinking like, hey, all clear, we should short the market because it's gonna, it's too good to be true, right? Well, the market has a great way of, staying complacent and really driving a lot of people crazy. So I actually think you could continue to see volatility come down, and that might have been the volatility bout that we're going to get for the remainder of 2025. You may just get into a melt up phase. And my personal opinion is it's not comfortable. Prices are expensive. Let me show you some valuation stuff. We're looking at historical PE ratios for the technology sector at all-time highs. That means stocks are really expensive. But let me be very careful with this, because again, expensive does not mean they cannot get more expensive. There are things in markets that drive people crazy, which are the idea that like, hey, stocks are at highs, they're expensive, they have to crash now, right? Well, that can take a lot longer than people think. And maybe you look 5 years from now and you say, yeah, the stock market was expensive, but maybe between that 5-year period, stocks also went up another 20, 30, 40%. When markets get into euphoria and crazed mode, they can do some pretty wild things. So is shorting an all-time high a wise decision? Obviously, that is up to you. I'm not here to give you financial advice, but historically speaking, all-time highs are bullish for markets. And though I don't have the stats in front of me, you should absolutely look that up. Ask ChatGPT. Historically speaking, all-time highs in the stock market precede stronger, more all-time highs, generally speaking. Momentum is a real thing in markets. So instead of fighting it, wait for pullbacks. That's my approach. That's my opinion. Stay diligent, don't leverage, don't be silly. That's the way to blow everything up. But a good thing is momentum, riding trends, and doing so without leverage, without taking exuberant amounts of risk. That's how I've done what I've been able to do in the financial markets, which I'll show you my P&L or my performance for the last several years. So here's a look at my portfolio on Webull. You can see we are up 293% on my public portfolio. And while this is not my only portfolio, I've kept this public since I started it in March of 2020 and have consistently and considerably beaten the S&P 500's passive return. And I say that because I've done this without leverage. My max drawdown was comparable to the S&P 500. And if you like this sort of stuff, if you want to see some trading performance stuff, stay tuned, because on Saturday, I'll be dropping a full review of my trading performance since inception on my account to keep transparency a key component to my YouTube channel. I've talked about trading because I love trading and I love investing. I love financial markets and I love learning more each and every year. If you enjoy it too, hit the thumbs up button, subscribe, turn post notifications on, and come back tomorrow where you can watch my video where we'll be going over my trading performance through the entirety of my trading account that I've had public on YouTube. Thanks for watching. Have a great weekend, guys. Hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.